Schorge. I'm the founder and the managing partner of Isomer Capital. Isomer is an independent investment firm based in London. We focus exclusively on European venture capital, and we invest through three main routes: primary investments into venture funds, co-investments with those same venture funds in some of their star companies, and then buying secondary pieces of either funds or companies when our fellow investors would like to seek liquidity, would like to exit along the way. Well, there's a lot of emerging trends right now to do with capital markets. We've been through a period of public market decline, of course, an interest rate increase, and there's a tendency of venture capitalists to live in their own bubble, to live, within the tech world and to focus on the tech trends, and those are very strong. So the world needs technology, the world needs digital solutions, and so within our little venture capital bubble, the trends are very strong, and you can read about generative AI on the cover of a magazine every day. Clearly these technologies and a range of others are really improving life and causing efficiencies in big companies and so on. That's great, but I think the aspect I would ask people in my market to focus a bit more on are the bigger picture of capital markets. We've lived through a 12-year run where every year was a record and everything was rising, more investment, more capital activity, growth. Great, really happy, and the vibe here at the conference today is very strong as a result and very buoyant. However, in capital markets, we're experiencing something very different. We just had a panel about exits, about selling. It's important in VC that you create great companies and build them up, but also that you sell. So that asset management component of managing venture funds is very important. And I think one of the emerging, the not so good emerging trends are lots of markdowns as companies try to raise capital. They come back to capital markets and they find that investors aren't paying the prices they were a couple of years ago. And so we'll see a lot of write-downs or flat rounds with structuring put on. So in order to preserve the NAV level of the last round, then there'll be lots of terms put on top of it with liquidation preferences and things like that for new investors, or share types converting for non-participating in a damaging way to earlier investors. So, I'd much rather talk about tech trends, but unfortunately I feel that some of the important trends right now are to do with the fund management business and the business of capital markets. Oh, well, venture, one of the reasons I love venture is it's always evolving. That's the nature of innovation. So whatever worked last year is not going to be what works next year. And LPs know this from data where the perseverance of returns is far less in venture capital than it is in buyout and credit and other areas where the same playbook works. So technology evolves, entrepreneurs evolve. One funny venture capital truism, the VCs get older and the entrepreneurs get younger. So that means firms need to adapt, and there's non-stop creation of new firms. So I'm surprised, to be honest, here in the middle of 2023, the number of new firms being launched around a new thesis, a new team, or a spin-out team, continues to be very high. And we meet usually between 2 and 5 every week of new groups. And I would expect in a more challenging environment that would tail off. But that highlights the idea that innovation investing continues to evolve. And funds arise around opportunity sets. And what you see in technology is that the opportunity sets change around certain geographies of excellence in a certain area, or sectors that are growing, or even new sectors. Who would have thought 10 years ago there'd be a range of crypto funds? It was too early to see that coming, right? And there are a range, and crypto prices are depressed. So probably a really interesting moment to put some money there. Not your whole allocation, but maybe something, And then on the other side, venture is always fashionable. So every year we have a fashion, and if you can put that acronym on your presentation or you can talk about it in an article, then pricing goes up and capital follows. That's not a good thing. So right now it's all about AI and generative AI and subsets. Nobody talks, well, we see less talk about machine learning and the real elements of AI, but AI has captured the popular imagination. You see it on magazines and broadsheets, and that means that funds are rising out of that. A lot of money is chasing that. There's real value there, and there's a lot of great investing that will be done. However, I do worry about the hype cycle, and right now that's the hype cycle. The other area is climate. So we need more investment into climate solutions, into things that help the world heal, and that's happening. I just hope that it happens with prudence and care and thoughtful investing, because just dumping money or throwing money at the problem is also not, like in every other sector, it's not the solution. So I see, again, in a good, net good, lots of money flowing that way, but I try my best to influence where that money can have its greatest impact, real impact. Because ultimately, if you don't build a product that helps the world and is very broad and successful, in other words, if you don't build big companies, you don't have big impact. So I see that the investment agenda is completely on the same page with the climate agenda, but as always, execution is the key. So getting it right is the difference between great success and changing the world versus, good intention. I'll bang the same drum I always bang, back to fundamentals. What do tough economic times mean? Well, on the capital market side, lower valuations, more time to do due diligence, a tougher negotiation with companies as you're funding them. That's all good for the investor. Can be difficult for companies. If companies need to raise and they're not able to access capital markets, that'll be a problem. So what we will see over the next year or two, a lot of companies will go away. There'll be a lot of early stage projects shut down, and even bigger companies that die. That's overall a healthy thing. Not every venture capital project will work. We know that, it's built into the model, but that's coming. And so as an investor, how can you deal with that? Or as a founder, how can you deal with that? Look back to fundamentals. And it's funny, I find myself saying it often, but it always comes back to the same thing. Can you build a great product that customers need and are willing to pay for? Everything comes back to that. And you can raise money and you can have companies progress, but ultimately it comes back to, is it a great product that customers love and buy again and again? It does good things for the customers, and therefore margins stay high. And that's pretty much true within consumer, within B2B. The way those markets work is different, but back to fundamentals. And for me, fundamentals also means funding companies at sensible valuations in line with their growth plans. So agreeing growth plans with the founders and executive management teams. You're going to do these following things over the next 18 months, for which we're going to fund at that level. And that to me is bottoms up thinking and fundamentals thinking, which is a healthy way to build. Whereas the top down, hey, everybody wants into this company, it's really great. That makes me nervous, and we're in that part of the cycle now where that top down thinking is getting its comeuppance. So we're seeing a lot of write-downs and a lot of companies that won't be able to raise capital on the valuations they did just a couple of years ago when valuations were very high. Oh, well, I'm passionate about a lot of things. We just today announced our new fund, Isomer 3, our flagship vehicle. It's out in the market now. It started, it's made a series of investments. We need to raise the rest of it, but that's exciting. So I think investing right now in the second half of 23 and 24 is going to turn out to be a great moment for all those reasons I mentioned, that prices are cheaper. If you can identify fundamental value, you can buy bigger pieces for the same amount. So I'm really excited about that. Isomer has always been about doing more for our end customer, which is the founders of Europe. And I'm working on a number of big ideas, which I can't talk about yet, but which is really doing more with those groups that we work with. And I think over the next year or two, we'll be able to announce some new initiatives. Still all about Europe, all about tech, all about building great companies. But as the capital market in Europe matures, more sophisticated tools are needed, and Isomer is arising to meet those needs.